Right.
Hello, everyone. This is the Money Smart Show today, June 1st, 2024. And our special guest today is James Lavornia from New Jersey. And he's going to give a presentation on taxes, how to save on taxes and how it applies. He will explain everything about that. My name is Brian Johnson, the Moon Run Report, and I am president and portfolio manager. And here we go. Here's a disclaimer. This talk on portfolio management and drawdown control is designed to educate investors to identify clues to the market based on stock market data. There is no guarantee that any signal will be timely or accurate. Investors should be aware that the analysis here is designed to inform, not avoid all losses that might be incurred. Past performance does not guarantee future results. And we're bearish. Here is why. I have a system, the Moon Run system, which has four different ways of calling the sharp market declines. One is the tsunami indicator. Then there's which identifies if you have if the market stalls out and the internals start falling apart. Then you have a bad situation. And next is the 50 new lows rule, which is the situation where the market goes up and also the number of new lows is going up, and you don't want that to happen. And when that happens, that signals a very bad market after that. The other one is the accelerating new lows, when the market starts plummeting and the number of new lows just starts to expand like you wouldn't believe. And then the last one is the shortable correction, which is what we are in now. Okay, here in November of last year, we were going through. There was a major buy signal here, and we went in. This turned out to be a minor sell signal, so we did not come out of the market. Stayed in this, and the market started going back up. Now we have a shortable correction here, and the market's going down a little bit. The idea is that the market's just it's going to suck. Okay, it's not going to do anything. Low volume, no participation. Everybody's waiting for data to come in. They don't know whether it's going up or down. And then we have a minor buy signal here, which means we just stay out of the market if you want. And so that's the idea here. And here's the market strength indicator. When it's about 3.8, the market's strong. When it's below 3.8, the market's weak, and all that type of stuff. And here it is. So we're going into this situation here where the market is strong, but it's not doing so great. And so, anyways, that's the idea. The market strength indicator is based on advanced decline, up down volume, new high, new low, VIX, and price, and you add them up and you get numbers. So that's what I do. Here's the confidence index. New York Stock Exchange on the top, NASDAQ on the bottom. Okay, as you can see, it is going up, but it is tailing off a little bit here. As you can see, it's not going up as fast. The difference is coming down a bit. And when it crosses down, that's a good time to be out of the market, but also after a while, this is based on the three things minus price. Okay, advanced decline, up down volume, new high, new low, minus price. And surprisingly, it gives nice signals. As you can see down here in November, it gave a good buy signal here and up over here too. Also, the trend was changing, but that's about it. Now the market is also this is the internals product. Just the internals, up down volume, new high, new low, and advanced decline. And when you add them up, you get this kind of curve. It confirms the buy signal here, and then it goes just kind of going up and down, just no direction at all right now. And it is kind of overbought. You can see a 1.6 here, and it goes to I think the upper limit is around 2, and it's coming down. And so it's on the upper limit, and that's what it is. This is going down. This is going down a little bit. So it just doesn't look very good. Okay, so that's the opinion. Okay, advice. Here's my advice on how to prepare for retirement. Pay your bills and don't argue. Okay, that's one thing. That's what you're going to do anyway. what the heck, and then trying to make as much money as you can is fantasy, because you will have an upper limit, you'll reach your goal, and that'll be it. But as long as you can pay your bills, that's the idea. Don't get into trouble trying to argue people about how much to pay or anything like that. Just get it over with. Money Smart Show. Few people attend, and I'm not getting any new subscribers. The idea was good, but the results are not so good. And I have stopped my relations with my agent in New York. She actually did a good job. I said enough and done enough. If people don't get it, I will not labor the point. I have written articles, I have done reviews, and I have done it. And that's enough. I am making enough money in the market to support myself, and that's the goal anyway for me. And I need to go in a different direction. The best PR attempt for me is the Holbert Financial Digest. I've been there for 3 years, and for the last year, I am #1. So that's what I'm going to do. Okay. Shortable correction. This is what the shortable correction signal on April 10th. Rate of decline, less than 1/9. The market's going down. It's a correction, not stalling out. Number of new lows at the top of the market in what was greater than 30 and greater than 60 at the sell signal being sufficient for a shortable correction. And then there's another test, the accelerating new lows calculation at the sell signal is greater than 40. So, and then after that, we had a minor buy signal, and then we just stay out. But, how the moon run report and how you can use it. $10 a month for the moon run report. First month is free, and that's I am President Portfolio Manager. The intent is to invest in proven portfolios to generate high return, sell out before the American bear market hits, and then buy after the bear market is over. Here's my track record. 2-time world champion, rode up in 2009. I'm doing 20% a year since 2008. However, Financial Digest, #1 for the past 12 months. There's going to be a new rating next week, maybe Tuesday or Wednesday. We'll see. Called bear markets in 2008, 2011, 2018, and research began in 2005 when I discovered the tsunami indicator. Okay. What the Moon Run report contains is 7 portfolios, small cap and large cap. I have decided after doing market timing for years, that's not all that great. The large cap portfolio, no matter if I time it or don't time it, gives the same results. Up, down, whatever. But the market timing is superior, but the large caps actually hold up very nicely no matter what, okay? And when you get the big bounce at the bottom, usually it eclipses much of the problems that you had with the bear market anyway, so what the heck. The large cap holds up, but the small cap portfolio does not. It gets pummeled in a bear market you wouldn't believe, like that. So I'm considering going forward to come out during the 3 bear market signals and just stay in during a shortable correction. The shortable corrections a little bit, then they come back. You can take advantage of the decline with options, but that's the way it is. There are 4 stock portfolios. Actually, there are 750 stock portfolios on portfolio 1, 2, 3 now. No charge. I'm putting there. Chart describe indicators for market direction, bear market signals. Okay, when to get back in the market. Then we publish an update on Friday nights, stock replacement on Monday mornings, and we need that. And first month free. Examining the portfolios. So as I said before, we have a new format. The Moon Run report portfolios have changed from timing to non-timing. Surprising, timing makes no difference in portfolio performance. But the timing I have is actually pretty good. It's not too bad. Called a crash in 2008. Would have done a good job in 2000 and 2002, but didn't do so great because the last change to the Moon Run system was the shortable correction in 2022. And that finished off the system, and I republished the book, and they look good. Okay, so they are available for subscriber anyway, and so You can enter and exit the portfolios when you go back in. The portfolios are there, so you know which stocks to buy. I don't have to come up and make a new portfolio for you, anyways. Okay, small caps. Back test from 1999 to 2024, 41% year again. With timing is 49%, but that's not too much of a difference. I mean, I'm going to live with it. And I don't have to break the bank every year if I don't want to. And 41%, I'm going to deal with that. Maximum drawdown, 68%. But if you sell out like that was in 2008, sell out before the bear market, you'll cut that in half or whatever. Turnover rate, over 400%. And then we have other qualities. Here's the chart, 650,000%. There it is at the top. From 1999 to the present. Large cap portfolio, back test 1999 to 2024, 23.83%. 24% is actually, that does much better than most of the money managers out there. You wouldn't believe how well it does. It's just a great system and has a good track record. And I'm running it on the Moonrun Report website. Maximum drawdown 50%, turnover rate 72%, which is actually quite low. Does a nice job. Okay, and the portfolio 24,000%. That's not too bad. Okay, all together, combine all the portfolios, 32% average compounded growth rate. Okay. Okay, let's check how much $100,000 invested becomes after 10 years. A large cap becomes $847,732. That's really good. Almost $1 million after 10 years. Small cap, $3 million, $3.1 million. And combined, if you do it together, 32.42%, and that's great. $100,000 after 15 years. Large cap, 24%, 2.468.24 for 2.4 million, 17 million for the small cap, and 6.7 million for that. Okay. No one calls bear markets like Brian. Okay, we have feature some things on the YouTube called the Money Smart Show. You go into the YouTube and type in Money Smart Show into the box, and up you come. You got 25 or more different shows there, the various different things about bear market and stuff. Okay, I'm going to go over the large cap portfolio code right now as I brought it off the internet, and this will finish the description today, and then we'll have our special guest today. Loop sum, current ratio. Okay, out of the last 5 years, current ratio has to be greater than 2.5 for at least 3 out of the 5 years. Okay, this gives good readings. Okay, gross margin greater than 5 for 3 out of the last 5 years. Return on equity greater than 0 for 3 out of the last 5 years, and free cash flow per share greater than 0.5 for 3 out of the last 5 years. Now, there are other qualities that you can assign to these things and get good, but these 4 things will actually do it for you. And a lot of people look at the PE ratio and they say, wow, that's it. But I don't care. PE ratio, it's a nice comparison, but it doesn't do anything for your portfolio at all. And so these 4, current ratio, gross margin, return on equity, and free cash flow, do a nice job. Now, current ratio and free cash flow are what, if you have healthy readings on those, it does a nice job of healing a lot of sins in the company. It really does. And then gross margin, return on equity, those are the ones that put the energy into the engine. So these all combine, and they do a very nice job. Price greater than 5, average volume greater than 1 million. Last sales, okay, this means the wash sale rule. And then for the sell rule, the trailing stop at 25%. So if you buy at 100 and it goes to 200 and then it trades back to 175, you want to sell. And then at the initial stop, 20%, you want to sell that. Okay, we have our special guest, James Livornia. James, we are
live.
We are on. We are doing something. I want to show you, do a few things. James Lavornia of Spencer Advisory Services brings a lifetime of financial strategy expertise to the table. As a leading authority in global estate planning and asset protection, Jim empowers entrepreneurs and families to harness novel approaches to wealth planning. So there you go. James.
Okay, let me just share my screen here real quick. And let's see here. All right. Can everybody see that? Hopefully.
Yeah.
That's my mug. That's my mug. Today I'm going to talk about different ways to save taxes on all that money you make with Brian's guidance. And hopefully you'll take his advice and do some of that long-term planning. Some of these techniques should fit in well. If you want to know anything about me, just scan that QR code there and you'll be able to just go to my website and see whatever you need to see. So let me just start in. Today I'm going to talk about tax mitigation tools for investors. And these concepts may not be familiar to some people, they may be familiar to others, but we find that a lot of people have not really taken advantage of this. So today I'm going to talk about strategic use of charitable trusts and bargain sales. It's going to specifically talk about the use of reversionary charitable lead trusts and charitable bargain sales. So it's a specific type of trust that we'll be talking about. So first I'm going to talk about Roth conversions, what they are. You might have heard of them. Roth conversion involves converting a traditional IRA or 401k into a Roth IRA. This offers several benefits, including tax-free withdrawals, no required minimum distributions when you retire, tax diversification, estate planning benefits, and then hedging against future tax increases. I'm not sure if there's anybody who doesn't think that with the amount of debt this country has, that there's not going to be any future tax increases. So a lot of people are catching on to Roth conversions. There are some limitations to Roth conversions, income conversions. And I know there's a lot of people that have 401ks or IRAs that $1 million, $2 million, $3 million, and they think they can't qualify for a Roth conversion. But there's something we call a backdoor Roth conversion. All right. And what that does, it's a strategic way to plan to get your money from taxable to tax-free. You have a designated account, which may be a 401k, and you basically roll your 401k into, say, an IRA, and then you do a conversion, okay, that moves that IRA from the taxable IRA to the tax-free Roth IRA, right? Or even a Roth solo 401k if you're self-employed. A lot of times some people have an individual K plan, they're a sole proprietor, they can actually take advantage of this as well, okay? But what's the downside to this? Doesn't seem like it's going to be all, roses and ice cream. You're going to get a 1099 for the taxable income. That is going to happen when you trigger this. So do you want to trigger all these taxes now or in 1 year or over a series of years? Maybe, maybe not. But what are the benefits of doing this? Well, number one, you have tax-free withdrawals in retirement. No required minimum distributions. In other words, the government can't force you to start taking out money that you don't need, okay, or want to pass on or keep investing. Tax diversification, all right. State planning benefits, okay. when you don't have to start taking money out of these particular qualified plans, you can pass them on to your heirs, and they can start taking tax-free income. Hedging against future tax increases. That's the big thing that most people are, are interested in. And so basically what you're doing is you're locking in the current tax rates. You know that at the end of 25, if the tax cuts are not extended, all right, tax rates are going to automatically go up. Current administration wants to even raise them higher than that. So you're going to be paying 50% plus whatever state tax is going to be. People are going to be paying over 50%. So would you rather lock in today's rates or take your chances in the future? So basically what it's saying is you have the opportunity to pay your taxes with lower tax dollars. Now, is that worth it to somebody who says maybe, 30 years old? Let's take a look. So if we convert, all right, money to Roth IRA, all right, or we put money in a Roth IRA, all right. So at age 30, let's say you had a $50,000 balance. So the taxes that you would owe if you did it all in 1 year would be $10,000. All right, with a traditional IRA, you have a balance of $50,000, you pay zero in contributions. Okay, now it rolls between age 30 and 60. All right, investments grow tax-free for 30 years with an 11% average annual rate of return on both sides, on the Roth IRA and the traditional IRA. Well, if you're following along with Ryan's newsletter and his recommendations, that 11% might be 32%. But right now, we'll just say it's 11%. It's basically what the S&P 500 has done since 1928 to 2022 is about 11.89%. So now we're going fast forward to age 60. Your Roth IRA balance is 1.3. Your traditional IRA balance is 1.3. Now you begin pulling out $50,000 a year in each for retirement on each side of the ledger, right? So here's the difference. No taxes are owed on the Roth IRA side, even though because you paid the $10,000 up front. But there's taxes owed on all contributions and in the investment growth, right? So if you take a look at age 60 to 85, total amount of withdrawals to age 85, if you start at age 60, all right, would be $1.25 million. The taxes owed on the Roth IRA was zero. The amount of taxes that you took out on the paid on the withdrawals is $250,000. Okay. And so that's assuming that the top rate for 10% of the taxpayers, okay, is 20%. So that's what they're using, 20% as a constant. Okay. I'm assuming if everything goes the way everything's being planned, what's going to happen is there's going to be a lot higher tax rates than 20%. It'd be more like an average tax rate of about 30%, maybe even more. All right. So, well, let's put it this way. How do we cut it? I don't know if you can see my cursor here on the screen or not, but I'm pointing to that $10,000 tax. How do we mitigate that? Okay. Well, in some instances you can't, but then just depending on what your lifestyle is and what you do, there's some things that you can do. All right. And they can be substantial. We have what we call a reversionary charitable lead trust, or a CLT. What that does is, or what that is that you have a donor, that's you. Let's say you have a pile of money somewhere, all right, that you're investing. This is not the same money that would be in your retirement plan. This would be other money. And you contribute that cash, all right, to fund a charitable lead trust. What happens is that every year you take money out of that trust and it goes to a charity, all right, or multiple charities, depending on who you are. And at the end of the term, which you pick, all right, well, you choose, the remaining assets in the trust come back to you or to a non-charitable beneficiary. So I'll show you a couple of examples of what we've done in that instance. Okay. You can also use a donor advised fund. A lot of people have those set up already. This was a case study. This is a client who converted $500,000 from their traditional IRA to a Roth IRA. And they then created a taxable event, all right, at that particular point in time. But by setting up $1 million charitable lead trust, okay, with payouts to different charities, they offset $300,000 in taxes. All right. So the remaining assets in the CLT would revert back to the beneficiaries in 20 years, right? Providing tax efficient growth. Okay. Tax efficient growth just means there's no taxes at all in that Roth IRA, because that $300,000 basically in this instance was the exact amount of the tax that was due from that $500,000. So it offset the taxes. So I know all of you have about $1 million sitting around and, just spare change. So we get another one here that probably more down to earth for most people. This one's a case of Joan Hansen, and this is a smaller donor, all right, that everybody probably could identify with. So Joan set up a charitable lead trust, all right, to offset future tax liabilities from a retirement account. Now, this particular woman is in her mid-60s, and she was charitably inclined anyway. She was giving away $15,000 a year. She had, we had set up a revocable living trust for her a long time ago. And she had, I guess she had probably about $300,000, $400,000 in a charitable, in an account under her revocable living trust. And, but she was taking money out of her annual salary, $15,000 a year, to give away to different charities. But in some years she was able to deduct it. In other years she wasn't, because of the large standard deduction that you currently have now. She's not married, so she was limited to about $12,000 a year. So sometimes she could use it, other times she didn't. The way this charitable lead trust works is that she chose she chose 14 years, okay, as her period of time that she was going to have this lead trust in existence. And so every year it was going to she was going to take $15,000 out of there. In the meantime, we had it invested. Okay. So if she had known Brian, we could have basically invested in his portfolios. In her account, she would use his guidance. So, but anyway, so what we did is she has also a 401k plan that had quite a bit of money in the plan. And we rolled some of that over into a separate IRA. She was allowed to do that with her plan. And basically what we're doing is we're taking out $25,000 a year. The $25,000 a year is generating taxes. Okay. We're also taking another 25 out to pay for a life insurance policy that she's going to leave that benefit to her kids. So she's got $50,000 a year roughly of taxes. So what we did is we took $250,000 from her one account, all right, in her revocable living trust. And all we did was journal it to a trust account after we set up the charitable lead trust. So it was in kind. She didn't even sell anything. Everything was chugging along like normal. And basically what that did, okay, is it moved her 14 years, I'm sorry, of $15,000 annually into one lump sum Okay, and from that, they took a present value, and she got approximately $200,000 of deductions that she's using to offset the $50,000 a year. Now, she's limited to 30% a year of her adjusted gross income, but that doesn't make a difference because that covers what she's taking out of her account every year, and you can carry that forward another 5 years. So she's in year 4 right now of that, and she's got 2 more years, and she'll use it all up. And then we'll try something else to start sheltering other income. Basically, that'll work for a small donor. And then what happens is that in her case, the money at the end of 14 years is not going to revert to her. It's going to revert to her 2 children and their grandchildren. So let me see if Brian, do I have enough time to go any more here? I've got another
Let's call it a day. Yeah, let's call it a day. James, thank
Okay.
you very much. We had a great time today. I'm sure everybody learned a lot.
Okay.
And we're here to share information that people might want to hear. So, James, Matt, thank you for running the show today. And I guess Larry Linsberger, thank you for being here. And we'll all have a nice time. Okay, that's it for today. Have a nice day, everybody.
All right. Take care.
Take care.